In the world of money, knowledge is power. One powerful tool is the tax accounting equation, or TAE. Dr. Joko Ismuhadi Soewarsono developed this equation. It's a simple yet powerful way to understand a company's financial picture. The TAE helps us see the relationship between what a company earns, spends, owns, and owes. The TAE looks like this. Revenue equals expenses plus assets minus liabilities. Don't let the equation scare you. We'll break it down into bite-sized pieces. This equation is about balance. It tells us that what a company earns must equal what it spends, owns, and owes. Think of it like a seesaw. On one side, you have the money coming in, that's the revenue. On the other side, you have the money going out, which includes expenses, and what the company owns and owes, which are assets and liabilities. The TAE helps us see if the seesaw is balanced. Understanding the TAE is crucial for anyone interested in finance. This includes investors, tax authorities, and financial analysts. It's a tool that can help you make smarter decisions. It's like having X-ray vision for a company's finances. Let's break down each part of the TAE. Revenue is the money a company earns from its operations. Think of it as the income a company generates by selling its products or services. It's the lifeblood of any business. Expenses are the costs a company incurs to generate revenue. These are the costs of doing business. Expenses include things like salaries, rent, and the cost of goods sold. Without expenses, you can't make money. But too many expenses can be a problem. Assets are what a company owns. This includes things like cash, equipment, and buildings. Assets are valuable because they can be used to generate future revenue. They are the building blocks of a business. Liabilities are what a company owes to others. This includes things like loans, accounts payable, and taxes owed. Liabilities are a normal part of doing business, but too much debt can be risky. Understanding these components is key to understanding the TAE. Each part plays a crucial role in the financial health of a business. By looking at these components together, we can get a clearer picture of a company's overall financial position. The TAE is all about balance. When the equation balances, it means that a company's financial position is sound. The company is generating enough revenue to cover its expenses, assets, and liabilities. This is a good sign for investors and lenders. However, when the equation is out of balance, it can be a red flag. It could indicate potential problems, such as underreporting revenue, inflating expenses, or misrepresenting assets. This is where things get interesting. An imbalance doesn't always mean fraud, but it does warrant further investigation. For example, if a company's revenue is significantly lower than its expenses and assets, it could be a sign that the company is in financial trouble. Or if a company's liabilities are significantly higher than its assets, it could be a sign that the company is taking on too much debt. The TAE is a powerful tool for detecting potential financial irregularities. It's like a smoke detector for your finances. When it goes off, it doesn't necessarily mean there's a fire, but it's a sign that you need to investigate further. The TAE is a valuable tool for various stakeholders. Tax authorities use it to identify potential tax evasion. By analyzing a company's TAE, they can spot red flags that may indicate underreporting of income or overstating of expenses. Investors use the TAE to assess a company's financial health before making investment decisions. A balanced TAE suggests stability and profitability, making the company a more attractive investment. Financial analysts rely on the TAE to understand a company's financial performance and make recommendations to their clients. By scrutinizing the equation's components, they can identify trends, strengths, and weaknesses in a company's financial strategy. While the TAE is a powerful tool, it's essential to remember its limitations. It's not a foolproof method for detecting fraud or predicting financial success. It's just one piece of the puzzle. Further investigation is always necessary to get the complete picture. The TAE is a starting point for deeper analysis. It's a framework for understanding a company's financial position. By using the TAE in conjunction with other financial tools and information, you can make more informed decisions about your money. Remember, knowledge is power, and in the world of finance, the TAE is a powerful tool to have in your arsenal.